Ladies and gentlemen, welcome to the Q3 and 9 months FY2024 earnings conference call of Lumax Industries Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anmol Jain.
Thank you very much.
Thank you, and over to you, sir.
Thank you very much. A very good morning, everyone. I hope everyone is doing well. Along with me on this call today, I have Mr. Vishnu Johri, the CEO, Mr. Sanjay Mehta, the Group CFO, Mr. Naval Khanna, Corporate Head of Taxation, Mr. Ravi Teltia, the CFO of the company, Mr. Ankit Thakral from Corporate Finance, Ms. Priyanka Sharma, the Head Corporate Communications, and SGA, our Investor Relations Advisor. The results and investor presentations are uploaded on the stock exchange and company's website. I do hope everybody has had an opportunity to go through the same. India's rise post-COVID as a manufacturing hub has been no secret. The world is seeing India as an alternative destination for manufacturing in place of China. This shift is evident from the PMI manufacturing data, which is soaring high owing to favorable government policies, be it the introduction of PLI schemes, FAME subsidies, focus on infrastructure development. All of these factors are playing a vital role for India's growth as a global manufacturing center and making India one of the fastest growing major economies in the world in the years to come. Coming to the sector, the automobile industry does play a key role in the development of India. Recently, in the interim budget 2023, Honorable Finance Minister announced a 7-fold increase in PLI for FY25 to rupees 3,500 crores for automobiles and auto components industry. We believe this will be crucial for India to indigenously develop and manufacture high-end auto components. Additionally, the government also mentioned about expanding the EV ecosystem, supporting manufacturing and charging infra, which will help in faster adoption of EVs in the coming years. Reflecting on 2023, India's passenger vehicle market saw record high sales of around 4.1 million units, marking more than 8% increase from the previous year. This growth was fueled by rising incomes, an expanding middle class, improved infrastructure, and a pent-up demand from the pandemic. Additionally, there was a notable increase in the electric vehicle adoption driven by government incentives and consumer preferences. In the two-wheeler segment, sales initially started slow but picked up in the latter half of the year, especially in rural areas, aided by festive demand and premium launches. However, the commercial vehicle sales saw subdued growth due to price hikes from emission regulations, while tractors faced challenges due to delayed monsoons. As we step into 2024, our outlook remains optimistic regarding a strong demand in the passenger vehicles and two-wheeler segment. The electric vehicle market is expected to continue its robust growth trajectory, driven by the small base and the government's focus on green mobility solutions, coupled with increasing consumer awareness. Coming to the sector, the evolution of automotive lighting is accelerating, primarily driven by the adoption of LED lighting, advanced driver assistance systems, commonly known as ADAS, and the pursuit of modern aesthetics. Traditionally, the large single-function lights occupied prominent positions on the front, rear, and the sides of the vehicles. However, newer, sleeker designs that elegantly wrap around the car are becoming more prevalent. The car manufacturers are leveraging lighting as a distinctive styling element and feature, integrating animations to embody brand identity. These innovative designs not only enhance the visual appeal of vehicles, but also serve practical functions. They contribute to improve the visibility for drivers, ensuring a safer ride. Additionally, advanced lighting technologies enable adaptive features such as automatic adjustments based on driving conditions and surroundings, further enhancing the safety and driving comfort. Some specific business updates. On November 1, 2023, your company has started the commercial production of automotive lighting at its new manufacturing facility at Chakan, Maharashtra. I am confident that this state-of-the-art modern facility will have a significant contribution in the company's top line and bottom line in the years to come. Also, on the order book front, the company has a healthy order book of rupees 2,200 crores, out of which 64% is new business. LED is 85% of the total order book, and EV contribution is 34% of the total order book. To meet the same, the company is also considering and is in discussions to further expand its existing facilities at the recently inaugurated Chakan plant as well as the Sanand plant in Gujarat over the next 2 years to meet this incremental demand. I now hand over the line to Mr. Sanjay Mehta, the Group CFO, for financial updates.
Good morning, everyone. Let me explain the operational and financial performance. With respect to segment mix for 9-month FY24, as a percentage of revenue, 67% is from passenger vehicles, 27% from two-wheelers, and 6% from commercial vehicles. With respect to product mix for 9 months, as a percentage of total revenue, 66% of revenue is from front lighting, 25% from rear lighting, and 9% from others. Regarding the financial results, I am happy to report that our business maintained its consistent revenue performance in the third quarter of FY24, with quarterly revenue standing at rupees 632 crores, depicting a growth of 9% on year-on-year basis. Revenue for 9 months stood at rupees 1894 crores, growing at 11%. The company reported consolidated EBITDA of rupees 60 crores with a margin of 9.5% in Q3, as against 57 crores in Q3 FY23, a growth of 5%. The consolidated EBITDA margin for 9 months is at 9%. During the Q3 FY24, the company has received rupees 26.47 crores as dividend from the associate company Lumax Limited, which has been eliminated in the consolidated financials. PBT before exceptional expenses and share of associate is rupees 23 crores in Q3 versus 29 crores in the corresponding quarter last year. The profit after tax stood at rupees 26 crores for Q3 versus 30 crores in Q3 FY23. The effective tax rate for 9 months is 41%, excluding the exempted dividend income, which is due to one-time write-off MAT amounting to rupees 2.10 crores, with company adapting the new tax regime at the rate of 25.17% from FY25. The capex incurred during the 9 months is 196 crores, which includes rupees 47 crores on leasehold assets. So actual capex outlet is around 150 crores, which includes 118 crores of new Chakan facility. The estimated capex for FY24 is 280 crores, excluding leasehold assets, which mainly includes balance capitalization of Chakan new plant and land and building of approximately 55 crores relating to PCB Bawal plant, which was part of capital advances till date pending statutory approval. With this, we can open the floor for question and answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Ashin Modi from Equirus Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. So my first question is regarding the revenue from new plants. So we have guided earlier that, H2 we would see strong growth. So could you please help us with that revenue from new plant and what sort of utilization is it operating at currently, and what sort of a growth do we expect from that in the coming quarter and the coming year?
So the new plant started commercial production 1st of November. In December, anyways, the working number of days were much lesser, and also because of festivities, we had almost 10 to 12 lesser working days in quarter 3. So the revenue for quarter 3, I don't have the exact number, but in quarter 4, you will have a significantly different revenue from the new plant. I believe the revenue was around 20 odd crores from the new facility in quarter 3. And this would be probably stabilized at about close to 30 odd crores per month in quarter 4. So we should be looking at somewhere around 90 to 100 crores of revenue in quarter 4 from this new facility.
And what could be the utilization at this 90 crores odd revenue in quarter 4?
What would be the?
Utilization. So this would be the peak revenue from the new plant? This 90 crores per quarter?
So the plant is divided into 2 phases. As I had always mentioned, it's the phase 1 which has been already invested and gone into commercial production. This phase 1 would be almost close to 70 to 75% utilized, let's say by end of quarter 4. We will also probably kickstart the phase 2 expansion because as I mentioned, the cater to the order book, majority of the order book is also getting into FY25 P&L. So to cater to that, we will also have to kickstart the phase 2 expansion, which was always envisaged for the new Chakan facility.
And so my next question is regarding margins. So we've seen sharp jump in employee costs for the last 2-3 quarters. Is it just because of the new plant, and is it expected to stabilize?
So you're talking about the employee cost?
Yeah.
So the employee cost sits at about 13.5% for the quarter, which almost in quarter 1 was also at a similar level, 13.2%. But you're absolutely right. Some of it is because of the employee cost addition in the new facility. And as I mentioned, for the quarter, the facility has not really gone to full potential of its revenue. So you will see improvement on the employee cost in the subsequent quarters for sure.
Yes, sure. Thank you. I'll join back.
Thank you.
Thank you. The next question is from the line of Sunil Kothari from Unique PMS. Please go ahead.
Thanks, sir, for opportunity. Sir, Hyundai is very seriously and sincerely talking about investing and growing very highly, at a rate, because they have very good export stage also. So other than SL Lumax, can we participate through Lumax industry in the growth journey of Hyundai?
Kothari, thank you very much for your question. The answer is very simple. We have a very clear understanding with our joint venture partner that the Korean business of Hyundai will continue to be catered by SL Lumax, and all the other OEMs will continue to be catered from Lumax Industries. So I do not see any opportunity to cater to Hyundai business from Lumax Industries anytime in the near future. However, we do share a very close relationship with SL Lumax, and if there are any common synergies which we can derive from a manufacturing capacities or some certain other aspects, those will definitely be explored.
And sir, one more question is on the journey we are moving towards higher margin, improving productivity, reducing cost. Qualitatively, if you can talk something more on this. And second related question is, if you would like to revise any guidance for maybe current year, next year regarding revenue growth or margin, because I understand, sir, business is not the thing which you can predict every quarter. It should grow at 15 or 12 or 18%. But you being since long in the industry, if conservatively, if you would love, it will be better if you can talk something which is achievable and which should be and will be achieved. So both collectively, if you can talk about, may not be the last quarter, for the fourth quarter, but for next year.
Sure. So I think if you see the performance from quarter 1 to quarter 3, of course, there has been a steady climb on the operating margins. And as I've always mentioned, there is a lot of focus on expanding the margins. So my guidance would be then for quarter 4, we would definitely continue this journey of further improvement, and we should be able to see a better margin realization in quarter 4 compared to the quarter 3 of the current fiscal. In terms of revenue growth, we've already seen 11% growth for the 9 months period, and majority of that, let's say 12% growth was what was seen in quarter 3. I'm talking about purely manufacturing revenues. But quarter 4, we're expected to see a much stronger growth, because of the new plant realizing all 3 months, and also there are more working days in quarter 4 compared to quarter 3. So we are looking at possibly even a 20 to 25% revenue growth in quarter 4 compared to the previous year quarter 4. So that would be my guidance on quarter 4 revenue. For the full year, I think it would be safe to say that we should be looking at around 15% top line growth as a company compared to the previous year. And only my guidance for next year would be that we are very bullish, even though there are certain industry analysts which are talking about a single digit, maybe 4 to 6% growth as an industry. I think we will continue to look at a much stronger double-digit growth. Based on the order book, it seems that anywhere our growth for next year would be even better than the top line growth of this year. So if this year we're growing at 15% expected for the full year, we're looking at surpassing that growth number for the next financial year. And
regarding margin, sir, for next year, because we are inherently in our inside also, we are trying very hard to improve productivity. We have appointed the consultant, and we are doing really very hard to improve the profitability. So what type of effects you conservatively expect on margin for next whole year?
So I think for the next whole year, I would continue to say that we should be getting into the double-digit space as an EBITDA margin. Even for the current year, if I look at a full year revenue, we're looking at almost anywhere between 2,600 crores or so, upwards of that for the full year. And at the EBITDA margin for current year, I would still feel that it would be anywhere around between 9.3 to 9.5% estimated. So definitely with the further incremental revenue growth in FY25, we will see a further expansion in the margins, and I am pretty hopeful that it should be, if not better than 10%, then at least it should be hitting the 10% mark for next financial year.
Great, sir. Thank you. Wish you good luck.
Thank you. Thank you very much.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Thanks for the opportunity. Sir, the current monthly run rate for the Chakan plant is 30 crores. So what would be the peak revenue on monthly basis for Chakan plant at 100% utilization?
So, are you talking about phase 1 by itself?
Yeah, phase 1 and phase 2 both.
So phase 1, at an optimum full capacity utilization, the monthly run rate would be close to around, let's say, between 45 to 50 crores. This would be the estimate. So looking at an annualized revenue of roughly around, give or take, 500 to 600 crores. And then with the going online of the phase 2 expansion, we do expect that somewhere in FY26, the peak revenue from this facility, phase 1 plus phase 2 put together, should garner around about 900 crores of annual revenues. So this would probably be one of the single largest manufacturing facility for the company in the coming time. And a significant part of the order book will go into commercial production in this new facility.
So you are talking about the 22 billion kind of the orders right now. So these 900 crores also included in that?
So 2,200 crores is the order book, which is the new orders. when you're talking about 900 crores, this is the revenue for Chakan new plant, annual revenue after the phase 2 expansion is completed, out of which I mentioned the 500 to 600 crore revenue, this is not part of the order book. This is already productionized. So there is a difference between the order book and the revenue coming from the plant. But yet, out of the total revenue of the company in FY26, approximately 900 crores of contribution will come from this plant.
Okay. And what is the difference in the margin from the new plant versus old plant?
So again, there are various plants. Let's say out of the 9 different facilities, they all operate at a various different margin. But I would say that the new facility is in line with one of the benchmark facilities and operates at a high EBITDA margin, and hence the revenue contribution from the new plant will also start expanding the bottom line, the margins as well.
So, what is the difference in the margin, especially for the new plant versus old plant? Last quarter, you had mentioned that the new plant margin would be 150 to 200 basis higher. In this case, as the 20 to 25% revenue will come from the new plant, there will be significant expansion in the margin. So, is it the right assumption?
Yeah, it's the right assumption. I still continue the same guidance of 150 to 200 bits incremental increase in the margins of the new plant compared to the previous plant.
Okay, sir. And my last question on the SL Lumax, what is the revenue and the PAT of the 9 months?
I see. For 9 months, SL Lumax is around 2,000 crores, precisely 1,933 crores.
2,000 and PAT?
PAT is around 170 crores.
Okay, sir. Thank you. Thank you, sir. That's all from my side.
Thank you.
Thank you. The next question is from the line of Harshal Shah from AM Investments. Please go ahead.
Hello. Hi, Anmol, and hello, everyone. My question is, Anmol, can you talk on Maruti business for a while? Like, can you talk about the EV development?
So what would you like to know? I mean, we all know that
Maruti itself said that they are coming up with the EV model for export markets by end of this year. So, is there anything like, have we won that business, or are we going to supply for that model?
So yes. So number one, Maruti will launch a series of EVs from now until 2030. I believe there are about 5 or 6 EVs which are lined up. We have already got confirmed orders for the first EV, which is slated for launch later this year, and that is a part of the order book. Yes, that EV is also set to be exported out. You're absolutely right. We are also in discussions currently for potentially getting the business for the second EV, which was slated to probably come sometime in FY26. So that is our current engagement with Maruti Suzuki on the EV model. However, I would also like to say that the first EV from the Mahindra stable, the first born electric vehicle, is also sometime expected later this year, for which the company is also got confirmed orders, and that is the model which will get productionized in the new Chakan facility.
Okay. And anything on the old models for Maruti, like, are we getting new business? Have we gone to the company and said ki our share has become less? So,
yeah, of course, that is an ongoing discussion. We already have secured multiple businesses for Maruti Suzuki, both replacement as well as new platforms. So that is one of the reasons why we did expand the Gujarat facility as well. So there will be a series of new products which will be launched specifically for Maruti, both in NCR as well as in Gujarat.
Okay. And Anmol, gross margins were higher by 150 bits quarter on quarter. So do you think these margins are sustainable, or like can we improve from here? Because we really feel we can do 10.5, 11% margins from the new, even from the new plant, and combination of both, new and old. So do you have the same feeling, or like what do you think?
So absolutely, I just mentioned it a while ago that going forward, we will definitely maintain the margins which we have already achieved. I do expect a further improvement in the margins in quarter 4 basis the higher realization of revenues, more contribution coming from the new facility in Chakan, and thereby giving a little more fixed cost rationalization. So definitely in quarter 4 by itself, I do see that there will be a steady improvement on the margins. And in FY25, I do continue to believe that the margins will further expand basis the top line growth as well as all the other cost saving measures which the company is undertaking.
And can you explain what led to this 150 bips improvement in margins? Quarter on quarter, like.
So I think there have been operational efficiencies. There have also been a better realization on the raw material consumption. If you see the raw material consumption on the quarter, it has reduced compared to sequential quarters or year on year as well. There are certain costs which have not really been optimized, like the manpower cost. There is still a higher manpower cost because of the new plant, which will get, let's say, proportionately optimized in quarter 4. There are series of things.
Okay. And last thing is, what is your outlook on the industry, like 4-wheeler, 2-wheeler, and 3-wheeler? Just broad outlook.
For next year?
For next year, yes. How is the industry looking like?
So I believe that whatever I have heard, the industry continues to be positive. However, the growth momentum compared to this year is expected to slow down, specifically in the passenger car industry. The reason for that is not that the demand is going away, but the reason is that the capacity is a crunch across OEMs. Most of the new capacities which the OEMs have planned only kick in H2 of FY25. So we do expect that also general elections being around the corner. In H1, we do see a subdued growth. However, the reason I'm still confident of our growth prospects being much better than the industry is because we are not growing specifically from the organic volume growth. We're actually driving the growth based on new model launches. So that's one of the key differentiation factors why we are very bullish about our growth prospects for FY25 vis-a-vis what the industry prospects look like.
Okay. Thank you, Anmol. Thank you. That's it from my side.
Thank you very much.
Thank you. The next question is from the line of Jatin Chawla from RTL Investments. Please go ahead.
Hello.
Yes, Mr. Jatin, please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is this order book of 2,200 crores, just to understand how you guys calculate it. For example, the Punch EV got launched this quarter. So is that still part of the order, or once you have launched the product, that's now no longer part of the order book?
So once a product goes into commercial production, it no longer sits in the order book, it goes into the P&L. And the order book is only corresponding to the orders which are still under development.
Understood. Okay. And so for both the Punch and the XUV700, now are you I think XUV700 you are the second supplier, but Punch, are you the sole supplier? Punch EV?
That's correct. We are the sole supplier for the Punch. Correct.
Okay, thanks. My second question was, so for FY24, at the start of the year and I think even till last quarter, we were thinking that we will have a 20% kind of growth. And it seems now we will be around the 14-15% mark. So this 5-6% shortfall, is that a function of some order getting pushed out or industry demand being lower than what your expectation was? What is kind of driving this shortfall?
So I think 2-3 reasons. I think number one, certain models have been deferred for FY25, and we do have a significant tooling revenue as a part of the total revenue pie. So that gets pushed to FY25 vis-a-vis earlier envisaged for FY24. Secondly, I think there are certain models which have not really done as intended by the OEM in terms of the volumes. And number three, I think there was a certain delay of about 3 months with respect to getting into the new Chakan facility, which also gave us a bit of a loss of 1 quarter revenue.
Understood. In this phase 2 Chakan, so broadly, is that a 50% capacity expansion?
It would be about a 30% capacity expansion because the installed capacity would go up by maybe about 30 to 40%, anywhere around that.
Because I think you said phase 1, 500 to 600 crores, and once both are done, 900 crores. So I was thinking whether you're looking at a 50%.
So the revenue and the capacities do not necessarily always correlate. The capacities are more generic. We could produce, lamp A or lamp B, depending on the per vehicle settled price. The values may completely change. So from an installed capacity, I think we are adding about 30 to 35% further installed capacity, which can give us a revenue upside of even probably around 40 to 50%. Because it's largely a 4-wheeler plant. It's not a 2-wheeler plant.
Yeah, got it. And this phase 2 would start commercial production by what time?
By later part of 24.
So let's say somewhere around Q3 of FY25 is when we expect commercial production to start.
Okay, understood. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Harshil Shetia from Ladder Up Wealth. Please go ahead.
Hello.
Yes, Mr. Harshil.
Yeah.
Please go ahead.
Sir, I had 2 questions. Firstly, what would be the net debt in our books for as of 9 months FY24?
So it is long term is 150 CR.
Correct. Short term?
And to take the total debt is almost around 560 CR.
560 crores. And cash would be?
Cash would be almost around 10 crores because dividend income has come later in January, so it is not there. If I take that, then the cash would be almost around 35 crores.
Okay. And what would be the capex that we are planning in the next 2 years for Chakan and Sanand expansion?
So we would not have the exact capex numbers yet because the products are still under designing and, we will still figure it out. But I think the only guidance I want to give here is right now the asset turns, if you see, of the company, let's say for FY24 end would be sitting at around 1.5, 1.6. Compared to the order book, whatever incremental capex we do in Chakan or in Sanand or in other facilities, it will be mostly a brownfield investment. And considering the order book, we do expect that this asset turn should improve from 1.5, 1.6 to somewhere around 1 to 2.2 or so.
Okay, so that should be around 3 times more or less asset turns for the brownfield expansion to bring it up by 50%.
Correct.
Okay. And so in terms of what kind of revenues are we expecting for that expansion? So you said a 30% kind of expansion will help us increase our revenues by 50% to the previous participant. So say for phase 2 Chakan and the expansion in Chakan that we are planning further up from there plus the Sanand. So what kind of revenues at peak utilizations are we thinking?
So let's say if I were to give you an outlook, current year, as I mentioned, let's say anywhere around 15% ballpark top line growth compared to last year, which gets us to anywhere around 2,600 crores or somewhere around that vicinity. Yeah. On that, I also mentioned that next year we're looking at a better growth on a top line. So the growth expected is beyond 15%, maybe 20% or somewhere around that, which will take the company to roughly around, upwards of 3,000 crores, 3,200 crores revenue in the next financial year. This is a guidance or the forecast for next financial year. And once we get the capacities in place and the order book, which kind of more or less kicks in by FY26, we do expect that this growth could be anywhere around 4,000 crores or upwards for the company as a whole.
So say suppose 4,000 crores and we assume an asset turnover of 2.2 times, which you just mentioned, you need a gross block of around 1,700 crores, which we are as of today.
So I mentioned that the 1:2.2 would obviously not just come into FY26. The order book which we are trying to invest in, that there is almost a 1,400 to 1,500 crores new orders in the order book. On that, the investment required would be for about 1:2.2 versus the 1:1.5 we are sitting at currently. So the investments for the new orders would be lower than what the current gross block to revenue ratio is.
Okay, so say our current order book is around 2,200 crores, correct?
Correct.
So if we say that just back calculating the asset turns, that means you need a gross block of around 1,000 crores for the new orders, not considering the existing plant or existing orders. So it's around 1,000 crores, correct?
Slightly lesser than that. It would not be, so about 1,500 crores is the new orders, about 700 crores is the replacement orders. So in the replacement, the investment is not so significant. There might be few investments because of the size of the lamp or because of certain specific technologies. But I'm saying that on a 1,500 crore order book, you can do the math of 1:2.2. And it's about 650 crores or up somewhere around that is what we would be expected to add to the gross block.
Okay, so just, the thing that I'm concerned about, because us as a company being Lumax, we always invest earlier compared to the order book. And that has been the trend of the company since the last 4 years, 5 years, what I'm looking at. And we always prefer to invest in our assets much earlier to the order book. So just the thing that I'm worried about is in case suppose we invest, say, in the next 2 to 3 years for increasing our gross block for the new orders of 2,200 crores, and with kind of a maybe suppose the orders go for a toss, or if there's a delay or in the launch or it gets pushed out or something, then we might be sitting on an asset which might be unutilized for us. So which is why I'm trying to do the math or, back calculate the investments that we are planning in the next 2 years.
So that's the business risk we all carry, right? I mean, no one can envisage or foresee what happens to the business. But I think any tier one would have at least a 4-month, any lighting player specifically will have a 4-month window by which we have to be ready for a OT, OP, OL, which is off tool, off process, off location before we hit into SOP. So that's the business risk we carry, but the investments technically get in about 4 months to 6 months prior to when the order book starts hitting the P&L.
Okay. And suppose if we are planning to set up a brownfield expansion, say suppose the one in Chakan, how much time does it take for the capacity to come to commercialization from the day we start spending?
Well, as I mentioned, right, I just mentioned that SOP of the Chakan Phase 2 is expected in Q3 FY25. We're already sitting in Q4 of FY24. So, we're looking at around 9 months or give or take 7 months for going on stream.
Okay, sir. Thank you.
Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Alisha Mahavla from Envision Capital. Please go ahead.
Hi, sir. Good morning. Thank you for the opportunity. First question is a clarification to what an earlier participant was asking. We said Chakan can do 600 crores of revenue. Is this replacement revenue where they're moving work from some other plant to Chakan? Or is this new business part of 2,200 that is moving to Chakan?
So Chakan, we are talking about the phase 1, 600 crores, which I mentioned?
Yes.
Yes. So part of it is a replacement or it's a shift out of the 600 crores. I would say approximately 200 odd crores would be a shift from the Gujarat facility because one of the models of Mahindra were earlier manufactured in Gujarat, and corresponding to that, we get a new order of a Maruti Suzuki model in Gujarat. So as a company, we still maintain that we get 600 crores additional revenue, but yeah, one plant to the other, it would have changed hands.
Understood, sure. And we've been saying that 2,200 crores of revenue, large part of it should start in 25. We were hoping that at least 80% of this order book sort of commercializes in 25. But we mentioned one of the reasons for probably hitting the lower end of the revenue target for 24 is delay in some models, and there is capacity constraint in upcoming elections. So are we expecting delay in execution of this order book now, and maybe not 80% of this comes in next year?
So, ma'am, out of the 2,200 crores, I would assume that around 15 to 20% of it would have already gone into FY24. I would say about 70% of it will get realized in FY25, if not 80%. 70% will get realized in FY25, and the residual 20 to 30% would get into FY26. So when I say 70% of it, please understand that we are talking about an order book which is calculated at the peak volume of the model. It's not necessary that 70% of 2,200 crores would be an incremental revenue in FY25 itself. You know, these models come into commercial production and they may take 2, 3, 4, 6 months to hit the peak revenue. So we calculate the peak revenue of the order book from a asset turnover, from a capacity and from an investment point of view. But from a P&L point of view, please follow the forecast which I mentioned or the guidance I mentioned in terms of a year-on-year revenue increase.
Understood. And just one last clarification back on Chakan. So the 30 crores of revenue that we did in this quarter and what we're talking during Q4, this is all primarily revenue that is moving from Sanand. Currently, there is no incremental revenue. Once the Maruti model starts is when we start seeing the incremental revenue.
No, so there has been an incremental revenue. For example, the XUV 700 was an incremental revenue, which commercial production was started directly from the Chakan facility. Also, the Tata Punch model was a incremental new revenue which started directly into the Chakan plant. Only the Scorpio model was moved from Gujarat to Chakan. So from the company's perspective, that has not changed. It's not an incremental revenue. And to offset that, the new model of a Suzuki, which is yet to be commercially productionized, that once that comes in, we will get revenue.
Okay, got it. Great. Thanks. Best luck.
Thank you.
Thank you. The next question is from the line of Prolin Nandu, an individual investor. Please go ahead.
Yeah, hi team. I just wanted to understand that slightly more to understand your business, right? And what makes predicting in terms of revenue growth and margin this difficult, right? And where I'm coming from is that if I look at your Q1 transcript, right, I mean, you were very confident of reaching double-digit margins in FY24. If I look at your Q3 transcript, and that call took place on 9th November, right, I mean, which was 40 days already in the quarter, we were very confident of reaching 20% kind of top-line growth and double-digit margins, right, in the second half. So we haven't been able to meet both those guidance, right, in some sense. So what is it that is making it so difficult to predict, and why are margins this sticky, right, I mean, of the ramping up? Because, I mean, any delays in the model, any delays in ramp-up in Chakan plant, we would have been well aware on by 9th November, right, when the conference call was there. So just wanted to understand does all these things take place at the end of the quarter when we come to know which are the models, or was there some delay spillover in the last few days of the quarter which led to the miss in terms of the guidance that we gave on top line and on margins?
So it's an interesting question. I think, number one, please understand we are catering to more than 24 OEMs. And when you're looking at the entire pie of the revenue, it's not necessarily driven by one plant. So while in one plant we are continuing to do it, there is a lot of volatility and variability across different OEMs. There are sudden, change in production plans. There are also certain production cuts. I think if you continue to look at how the industry has performed, and specifically if you look at, let's say, the Maruti Suzuki and Tata Motors and Mahindra, let's say, who are some of the top key customers, I think they have on a quarter-on-quarter basis also declined. Specifically, if you look at Maruti Suzuki in quarter 3, their volume has declined by 16% over quarter 2, right? Tata Motors has also declined by 2%, and Mahindra has also declined by 12% in terms of their production numbers. So we're a tier 1 supplier. Now, we have to, follow the forecast given by the OEMs, but if the actual production takes a negative slide for the quarter, then there is no way that we can continue to meet the forecast. Having said that, I'm still maintaining that, in a industry which is volatile, I'm still maintaining a 15% top line growth for the full financial year compared to earlier probably guidance of around 20%. So I think that's, still not that off from the earlier guidance. Coming to margins, I think I always maintained that our endeavor is to get to double-digit margins. We have seen a 150 bips expansion in quarter 3 for quarter 3 itself, and I continue to say that in quarter 4, you will continue to move up the needle from a margin perspective. So are we expecting a double-digit margin in the subsequent quarters? The answer is yes, for sure. We will continue to do that.
Sure. That's it from my side. Thanks a lot and all the best.
Thank you.
Thank you. The next question is from the line of Pratik Kothari from Unique PMS. Please go ahead.
Hi, good morning and thank you. So my first question is on the interest cost, which used to be 6, 7, 8 crores last year, has gone up to 12, maybe 13 crores this year, this quarter. So you can just highlight what caused it, if there's anything we can do about it, because this is now a substantial part of our expense.
So actually, if you see the interest cost, both we have taken the long-term loan for the new Chakan facility, which is started from the 1st of November. And also in the working capital limit, the interest is on the upper side. Although the repo is the same, but the banks over the time has slightly increased in that way. And when some new facility comes, the stock, etc. is also increasing. The utilization of working capital is also slightly increased. So that is the reason of the increase in the interest cost comparison to the last year.
Correct. And anything we can do to kind of stabilize or bring this down, bring the debt down, repay, maybe we have a few anything on.
No, what we have taken, there are 2 long-term loans. These have been paid as per the schedule agreed in that way. So over the time, this debt will be going to be reduced as per the payment terms what we have with the bankers. But this year, the total debt will remain below 600 CR, which as on date is of 566 CR. The reason is that because for new expansion, we have some more loan for which we have opened the LC.
Correct. And sir, in Chakan phase 1, how much have we spent till date? The total?
We have spent almost around 170 crores of the CAPA we have done, but the actual net outflow is almost around 100 and almost around 30 crores.
Okay, correct. And sir, in the past calls, our guidance or our aspiration used to be to do first 11% margin and then maybe go from there. Today you seem like, if we touch double digit, that's good enough for next year, 10, maybe some slightly over 10. So anything which has changed in terms of our margin outlook, why are we bringing it down? Our aspiration also.
No, I don't think we are bringing it down. I think there is a misunderstanding there. I think I have continued to maintain that the double-digit margin in FY24 is something which we would like to achieve. And again, for quarter 4, we are hopeful that we should be able to come as close as possible to achieving that target. The aspiration is still to get to a 11%, 12% EBITDA. Of course, it would not come in 1 year, but in FY25, we do expect that with the revenue growth, the margins will also further expand. So definitely will we be in the double-digit margin in FY25? My answer is yes, definitely. We should be looking at a double-digit margin in FY25, a comfortable double-digit, and then inching more towards 11% as we go forward.
Great. Thank you and all the best, sir.
Thank you.
Thank you. The next question is from the line of Ashin Modi from Equirus Securities. Please go ahead.
Yeah, Asha, I just had one question. So, was there any impact of mold sales on gross margins during the quarter?
No, there was a negligible impact of that. There was hardly any mold sales for the quarter 3, but going forward, possibly, we do expect a decent amount of mold sales in the subsequent quarters.
And this is generally margin accretive?
Sorry?
This is generally margin accretive, mold sales?
I mean, it depends on mold to mold. It depends on, it's not a generic, but yes, we do make margins on tooling sales, but in certain models, we may have a lower margin compared to some other models. So it's a mix of multiple factors. But again, in certain, I would say you should look at tooling for the full year rather than on a quarter-on-quarter basis.
Sure. Thanks.
Thank you.
Thank you. That was the last question for today. I would now like to hand the conference over to the management for closing comments. Thank you, and over to you, sir.
Well, I would like to thank everyone for joining onto the call today. We continue to remain confident on the growing prospects of India and the automotive sector in particular. I hope we were able to respond to your queries adequately. For any further information, I request you to please get in touch with SGA, our investor relations advisor. Thank you once again and have a nice day.
On behalf of Lumax Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.